Whenever Trump's around, there's a higher headline risk
Right.
of being invested, and it's an environment which we actually flourish. Our right-hand side coming out of the drawdown was steeper than going in, and that's because right in the eye of the storm, we recalibrated our portfolio, we redeployed capital to the best opportunities for the best price.
Welcome to Talking Markets, brought to you by Capital.com. I'm Michael Wilson, and joined as ever by veteran broadcaster and city pundit.
Sidekick.
That'll
Good morning.
That'll do, David Buick. And also very pleased to see we're joined by Mark Ellis, who is founder and chief investment officer of Nutshell Asset Management. He will ask you about the success of Nutshell in 2025. I'd like to get us right up to date and talk about the volatility that Trump appears to have stuck in the market by, first of all, Venezuela, then the possibility of Greenland. What does it do to your investment strategy?
Well, look, I mean, whenever Trump's around, there's a higher headline risk
Right.
of being invested, and it's an environment which we actually flourish, where we flourish. Our approach is very active, very relative value driven. We in essence run a live relative value framework for investing, and in a higher vol environment, it just spins out more opportunities for us.
Could you just be a little more? I'm not quite sure what you mean.
So, I mean, a good example was Liberation Day last year. We had that 20% drop in the market, and when you get that, and I don't know, the VIX probably was, I don't know, 50, 60, and when you get that high level of volatility of standard deviation of equities, things overshoot, and when things overshoot, we compare like for like across the globe and can identify opportunities. And when we look at our fund performance last year, if you look at the V of the Liberation Day, our right-hand side coming out of the drawdown was steeper than going in, and that's because right in the eye of the storm, we recalibrated our portfolio, we redeployed capital to the best opportunities for the best price,
Okay.
and we did very well coming out of that.
All right, thanks.
I mean, you indicated to me in a note we exchanged recently, Mark, that buy and hold is dead, or is dead in the water, or could be dead in the water. Do we think that is the case? So that's obviously an illustration. I mean, last year, Nutshell, amazing, 27% return.
Oh, the year before.
The year before, I beg your pardon, yes. Absolutely fantastic. And markets, despite geopolitical problems, this past year have done also remarkably well.
Yeah.
Can you elucidate why you think that's happened, and how well have you done in 2025?
Yeah, well, look, I think the markets have been exceptional last year. I think our performance was exceptional relative to the style and sector we invest in, and relative to our peers. A lot of our peers, we operate in what we call quality growth space. So established companies with a wide moat, a comparative advantage, which have produced excellent returns for sometimes decades. And that's where we look for our investment decisions and the stocks we invest in. Now, ironically, last year was probably the worst year for quality growth for a long time relative to the other index constituents. So we don't invest in natural resources like gold and silver. We don't invest in financials like banks. We don't invest in defense because they're all too cyclical and not higher quality for us. So our peers were pretty flat on the year. We managed to be up, I mean, in a dollar share class, we're usually around 70% invested in the US. So with less FX translation exposure, our dollar share class was up maybe 18%, slightly above the S&P, which I think is a right result, considering we have no exposure to those sectors I've mentioned, which did really well last year. Yeah.
So you still, therefore, look at fundamentals of companies,
Yeah.
whatever the circumstances, do you?
Yeah, exactly. So the highest, we are a quality growth fund, so the highest allocation of our kind of assets is to the quality factors, the pool of quality factors. Probably around 60% is allocated to quality factors. So things like high and stable return on invested capital, high and stable profit margins, kind of any of these moat analysis characteristics. So, and then we look at growth, 20% probably on growth and valuation, and then some technical factors as well. And we keep it consistent every time we run it. So we will not be invested in kind of natural resources where it's very cyclical. Their earnings can come up and down like
over the
yo-yo.
years.
Yeah.
But what about things like trashed companies? I mean, let me just not put words in your mouth. I mean, a company that I've looked at, which has just dispirited me, is Diageo. It's got a new CEO. People are drinking less, as we understand it, but you can change the nature of your company by taking that into account. Do you look at companies that have been wonderful investments but are now currently out of vogue, or do they really have to prove it to you?
Sometimes companies like Diageo potentially could get into the portfolio. We've never actually owned Diageo. I mean, I would say I would say Diageo was probably a quality stock of a decade or so ago. And since then, there would have been some red flags in its fundamentals. Maybe slightly volatile earnings profile, slightly negative margin profile. So that's why it never quite got into our portfolio. I mean, if I look, one of the interesting things about quality investing at the moment, going into 2026, is that we've had this rare underperformance to the index. So a lot of our portfolio is really cheap. So I would say we did an analysis in November, and when we looked at a decade's worth of PE multiples, 35% of our portfolio was in the cheapest percentile. So virtually the cheapest ever been over 10 years. And nearly half the portfolio was in the cheapest decile, the cheapest 10% of PE valuations over a decade. So there's some real value in some of the stocks we're holding. Some of the US software stocks we're holding, these are not recommendations, but the way we look at it, we think some of the software companies in the US are cheap, things like Fortinet, Adobe. We've just kind of pivoted aggressively back into Novo Nordisk on the back of this $150 a month pill that's released in the US. We think that's a game changer and solves a lot of their problems overnight. And even things in the UK, things like Auto Trader, we've been buying that aggressively over the last couple of weeks. We've got a few tailwinds for the investment environment for 2026. However, on the flip side, I would say we've got a midterm election year, and out of the 4-year election cycle, the midterms are the worst. They're probably the only one with a negative expected return, if you include 22 and 2018. And then also we've got, as you've outlined, we've got Donald Trump and any potential macro headline risk, which could evolve from what he's thinking, whether it's Greenland or Greenland looks like the odds-on black swan for the year, doesn't it?
But I mean, the one thing that just on the question of technology is that China has become quite quiet in terms of vocal comment. We noticed that in the electric car market that they've usurped Tesla for the time. And we know that Taiwan has been very important for producing chips. And I am slightly worried about the cumulonimbus clouds that are sort of hanging over Taiwan with the old Chinese napping the table, shall we, shan't we? But they are likely to come in with products not dissimilar, because their industrial espionage seems to be phenomenal, at a price cut that could perhaps bring pressure on companies like Nvidia or not.
Yeah, I mean, in theory, that's kind of what we saw in January last year with DeepSeek. So there's always that threat that there's, Alphabet came out with a chip, news on a kind of a competitive chip last year, and it had a bit of an impact. But look, I mean, relative to its quality factors, we think Nvidia is still good value. We actually only bought into it after its explosive growth in Q1 24, when it had that ridiculous explosive growth. That's when the kind of growth and the valuation factors flagged for us, and we were able to pivot into that stock. And we did really well. I think in 24 it was probably our largest contributor to returns. Last year it wasn't up there in terms of attribution, but we still like it. The other Mag 7, we like Alphabet. We've still got Alphabet. We've still got Microsoft. I think, yeah, that's it. So we've just got 3 out of the 7 at the moment, where we think there's a nice blend of quality, growth characteristics at reasonable prices.